Good evening, everyone, and it's nice to see so many faces. I think I've seen even much more faces today than we saw last time, and I'd hope to brighten things up a little bit. That's why I chose a white background, and I think it kind of mirrors what market sentiment is all about. And I think those are very exciting times in the Philippines, very clearly impacted into the stock market, and I hope to be able to try to guide you through in navigating through these types of market. I guess this is a little bit easier than what we've seen in the last few years, because a couple of years ago we were coming from a turnaround condition with, of course, a lot of heavy impact around the world, but now we're a little bit changing, although yes, there are some threats still around us, but it doesn't seem to be being felt too much into the Philippines. So clearly we still are and still will be in a bull market, and the only things that we're going to have to really worry about are the little bumpiness that we're going to be experiencing. But that should not change the matters in terms of trends, and I will be focusing on that in a little while. I did notice that some of you have been texting questions about whether our presentations will be available, and yes, they would be available. We will have the PDF documents available tomorrow, and I think sometime either Friday or Monday. Yeah, Friday or Monday we might have a little bit more of a YouTube presentation that you might be able to access. So if you guys want to be able to review things in live with what we've managed to do, you can also review it then. All right, so I'd like to be able to, of course, begin by giving you a recap of what happened first into the market. So this will be a technical orientation, and as I titled my report, riding the bucking bull. Let's see how bullish things have come, and of course what lies ahead of matters. Now, we've gone through a period of course, quite heavy advances into the short period of time, and that was clearly because a lot of the changes that have been taking place, you know, I think I can just easily remember not too long ago, maybe 2 years ago, people were talking about, oh my God, the next Great Depression that was about to happen. And of course, that kind of shocked the entire world. They had it on TV every single night. And of course, that got everybody worried. Nobody wanted to put their money into banks. And I think you can sympathize how scary it seemed during those periods. And of course, 2 years ago, we were telling everyone, no, don't worry about that. And you know, the natural tendency for people is to fix all these problems eventually. And we did see a little bit of a rebound in prices, but quite a number of the population remained quite bearish, and I think quite a number of them still do. And because of that, some of them were not really able to maintain themselves in this particular type of markets, but markets continue to move higher. And with that respect, I don't think it was too long ago that you also recall that people were talking about the great double dip. You still remember that? Still. And well, you know, we see all these threats coming by, and there's a lot of pessimism out there. And one thing the markets are showing you is, despite that pessimism, despite what you might see in parts of Europe, there are still quite confident people out there, believe it or not. And this is being reflected into markets, and like I said, we will still see that to render itself. And part of the reason that we're seeing quite an extensiveness of that really is because of the liquidity that it's managed to keep inside the markets. And I think April managed to be able to identify how those levels managed to grow. Now, the Philippines is, at least this time around, not in the middle to bottom end of the activity. We're on the upper end of that activity, finally. And it's not every once in a while that you get to pat our country on the back for doing a great job, and hopefully we can see more of that to be able to give us much more to be able to go on. Now, such movements into the Philippines, and also as April pointed out, will also need some adjustments, and so it's very normal that we would be experiencing some corrective adjustments to be able to handle some of the recent sharp movements that we've had. But do not lose focus. There are reasons why prices are going higher and have been extended, and they have not structurally changed, right? There could be some adjustments, but don't lose your focus on our targets. And that means that we're still heading up there. It doesn't matter what you're might be seeing into the short term. Trends are quite viably into that upside, and we'll have to be able to pin ourselves on that particular angle. Now, The other thing that we just have to be able to also try to address is how to be able to gear up to the matter, because of course the strategy involved right now is going to be a little bit different than what we were using in the last 2 years. A much aggressive market requires a much aggressive strategy. And in that type of condition, we may not expect prices to go all the way back down to levels that we wanted to, or perhaps some of us are waiting to happen. Maybe corrections could be slight, corrections could take time and just move sideways instead. And so these are the particular things that we're going to have to be able to build into our trading system, and we'll try to be able to see how to flesh that out a little bit later. Now let's have a look at how things have come to be. I have here on the left side, of course, the darling of all markets, and that's the Philippines. And if you can see, the Philippine Stock Exchange Index have been quite strong and advantageous in its push, especially in the short period of time that it's managed to be able to push back, breaking last year's highs, and of course still pushing above the 5,000 level not too long ago. Similarly, if you have looked there on the right side, you have the U.S. markets with the Dow Jones Industrial Averages, and it too managed to be able to break the highs that it also pushed out in 2011. So there is a quite nice similarity with what you have over here. Although the U.S. is still not at an all-time high, not like the Philippines is showing you right now, I hope that we're probably seeing ourselves moving into that category with the Dow. Now, looking to some of our other neighbors and looking at Germany and for example, in South America and in Brazil, let's have a look. Although we've seen quite a bit of a steep recovery as well in their markets, and mind you, Europe is really under pressure right now, but you can still see that Germany managed to be able to make a recovery, and quite a number of the healthier European indices also managed to be able to push up quite strongly. But unfortunately, they have not broken 2011 highs yet, so these are kind of a little bit more tame in their ability to recover. Well, after all, the fire is burning on their side, and they're slowly trying to be able to put it out. Similarly, we've had, of course, some pressure over in countries like in Brazil. This, of course, mixed with a little bit of some inflationary threats. And if I were to look at two more particular markets in particular, we have China up there and of course India below. And what happened over here in these particular countries is that sometime last year there were upside threats of inflation were taking place because of course their economies were doing quite well and were becoming overheated. And if you would see what happened as a result of short-term inflation, we could see that there was a little bit of some pickup in interest rates to try to be able to handle those little issues. Of course, everybody thought, oops, this is it, an interest rate cycle moving higher. But if you could see what's recently happened is interest rates have actually remained flat, because what happened in the long run is inflation actually tapered down. So it wasn't as bad as people started to expect. And with all this sell-off that we've been seeing in China and India, it came as a repercussion of their economies simply trying to slow them down because they were just moving too fast. Now, I don't know about you, but if I have a company and I'm trying to be able to move forward, and I'm only in that point where I'm arguing from strength, I'm just trying to slow it down to make sure I can last longer, that should not really be too bad now, should it? And so with the prospect of what they're trying to do to reinitiate that growth is to first slow it down so they can maintain that growth level at a much more comfortable pace. And I think that's the only reason why, of course, China and India managed to be able to pull back. But of course, in the short term, we had a little bit of some recoveries taking place, maybe not so much like the rest of the world. But I guess we can't have every single market across the world all moving in the same direction all at once. And maybe one day that may happen, but there will still be a lot of rotational efforts to be able to push that. And right now it's on our side. It might take some time for some of these other guys to be able to get back into the ball game. But by no means are they out of the ball game. They will come to be able to move back. Now, just to highlight, of course, one of the things that April pointed out, and I'd like to be able to also focus how come there have been some unevenness in this, is you can clearly see that if you were to look at the interest rate movements in some countries, India, China, and you can see also Australia, their interest rates have been on the elevated side compared to Germany, France, Canada, United Kingdom, United States, and Japan. You can throw us in here too because we've been trading at a 20-year low in terms of rates. So you can can clearly see that there is a low interest rate environment that is really drumming up activity and is forcing people to be able to move out of fixed income and trying to be able to look at some things that are a bit more aggressive in terms of their ability to have their cash invested. And this plays a very important role because it generates more liquidity flows, and this is where the money's coming from. They don't want to be able to stay too much staggered into one area alone. They're looking for very active avenues to move in. And if you could see what I'm showing you over here are U.S. bonds, 10-year U.S. bond values. And generally, they've been picking up. In fact, U.S. bonds have been picking up for the last 30 years. And we've been seeing every once in a while that after huge extensiveness in that, particularly there are moments in global situations where elevated levels of risk show. For example, right now, we saw that the United States, Europe, Japan were just coming off from a major blow in terms of their economic conditions. And Europe remains to be very much hard-pressed. And because of that, people took flight into safety, and so what they started to do was buy bonds and bonds and bonds, and because of that, you have a shoot up in bond prices. But if you notice what's been happening not too long in the few months now, we've seen bonds attempt to taper off, and in fact, recently, bonds have started to fall down quite big. And so you can see a very, very sharp pullback in the bond rates. And so what happens to all that money that's all being locked up into the bond market is now opening themselves up and now flowing back into more capable markets can generate much more healthier returns. And this is, of course, why the stock market has been quite a darling for many of investors. And so this is one of the reasons that you're seeing a continuing flow in liquidity. And by the way, the trends are going there. It looks like that correction should try to be able to continue, and that means outflow of bonds, more money into the equities market. Now, this is a graph, of course, back of the S&P 500, which is a broader index rather than the Dow. And you can see what's been happening as a result, of course, of that little outflow now into the bond market. You've seen quite a steady advance into their particular market. And like I said, they've managed to be able to break 2011 highs, and clearly the upward trend is very much intact. Although I think you can clearly see the price channel that I have drawn up there. And if you can see that we're kind of coming closer to the upper end of the boundary of that particular index. So this could be arguing that maybe perhaps some consolidation time maybe soon being warranted into the marketplace, and so we just have to keep ourselves very much alert for that. But remember, the trend here is still up. Now, to show you the relationship between, of course, the bond market and, of course, the stock market, let's look at those two pictures again. We have a 10-year bond placed up there. Below that, the S&P 500. And what I did is I just simply tried to be able to put one atop the other. And I wanted to just show you the relationship of the bond market and compare that with stocks. And if you can clearly see, when bond prices, you can see, are going quite elevated, you can see what it did to the S&P 500. It dragged it down. And then, of course, every time you see the prices are moving higher, you see the stock market heading down. Again, prices moving up, and you have markets heading downwards. So you can clearly see that there is an inverted relationship into this picture. And equally so, when you look into the bullish side of things, you can see when, of course, the bond market is heading down, you can see stock markets are pushing up. And you can see that in every green phase that you see outlined in this area. So with the bond market attempting to be able to pull back again, and you can see recently the stock market has been enjoying the fruits of that as you're seeing outflows from the bond market and moving back into the equities market. So I think you can clearly see part of that adjustment still taking place, and that means liquidity levels will still be rather high. Now, if you also want to see how the liquidity translates now into some of the currency aspect, let's see how it affects the dollar and, of course, how it affects our peso. Now, if you'd notice, since September of 2011, we've seen quite a bit of an up move into the dollar. And this was also a repercussion because we've seen some weakness into the euro. And of course, some of the structural recovery items we've been seeing in the United States have been a little bit stronger than what was expected. And so it's lending that strength back into their currency, and we're seeing some flows back into that, at least into the short term. Now, although this is still very much in the infancy of a larger potential turnaround situation, I think that we probably are going to see a sideways coasting dollar, maybe slightly higher. And it's because of that we've had some pressure into the peso, if you'd notice there on the right side for a while. But just to show you how much stronger the peso is as compared to the rally in the dollar, look at the highs that we saw in the surge of the dollar initially here, and compare that with the spike that we saw in the peso dollar rate right there. Then another surge in the dollar took place, but look what happened into the peso dollar rate. All we did was challenge the previous high. If you notice, this one we're making a higher high. And if you were to look at what happened now here, we have a slight pullback into the dollar rate, and you have a major pullback into the peso rate, dragging it all the way back down to the lower end. And as that picture there shows, if you see that value go down, that means you're seeing a stronger peso compared to the dollar. And so clearly, we are seeing some structural changes that's taking place on our side that is even mitigating the currency flows that you're seeing from here. And I think that paints a very good picture, and that should be able to keep any capital outflows from coming off our country and any threat of any potential increases in even a short-term devaluation. So we're still seeing very strong movements into our currency, and that also, again, keeps money intact into our part of the world. Now, if you'd also look into the commodities market, and I want to highlight gold here on the left side, and of course oil prices there on the right side. But let's talk about gold. Gold has been recently, of course, in the fury. This comes as a result of gold coming from maybe somewhere between $400, $500 per troy ounce. And we've seen an incredibly long bull market in gold for a very long time now. However, we are seeing some pressure coming out the gold market, and we've been seeing a lot of reactions and consolidations into the gold market, and that could possibly be because people had gone into gold in threats of inflation, in threats of the volatility that the world currencies were playing out. And since a lot of those little holes that we've been seeing have been being covered, and we see structural recoveries taking place, it is lending some strength and into that, and that's the reason why gold has managed to be able to at least try to ease off that very, very high horse that they've been holding. Now, I think it's very important that we're going to be watching this as a potential situation as it comes forward, because if we do see gold angling lower, particularly if we do see gold back here or lower, that could be telling us that there could be an unwinding now in this ability for people to see too much risk around the world, and that could keep the dollar buoyant, and that could eventually impact this, which is oil prices. If you see oil prices recently have gone up quite tremendously. We were not too long ago, last October, oil was doing about $76 per barrel, and we're sitting right now closer to about 109, 108. And the reason for that is, of course, there is parts of the world that's encountering some pressures, particularly because of the things we've been seeing in the Middle East and in that zone. And the same thing, of course, demand for oil remains to be quite high, coming from places like China and then, of course, other parts of the world, and that is adding up altogether to be able to push that, including the recovery into the dollar. And so with what we're looking at in there, and I would agree with April, if there's anything in the short term, I think we ought to be watchful of. It should also be any particular spikes that would come off this particular commodity, just in case. We have been hearing about potential aggravation taking place again in that part of the world, so we have to keep an eye to see how that will influence oil prices, because increased oil prices, that will hit consumer spending, and now that could put quite a bit of a pause into the global economy. Now, just to be able to highlight part of our observation so far is, so we've noticed that interest rates are still and are more likely geared to remain quite low. The high levels of liquidity are being poured on because, of course, the structural changes we're seeing and the recovery activities have been actually a bit more clear now than they were before. Inflation was not really much of a worry. Since the world is so focused on making sure that the world comes off, they're doing everything in their power to try to stimulate growth, but not to kill it. So they're not really feeding off too much that is causing too much inflation. And I think these two, the strength that we're seeing from Asia, the weakness we're seeing from the Americas and Europe seem to be counterbalancing each other, and that's why we're not really getting too high levels of inflation coming from our part of the world. Now, of course, these are all very supportive of the medium to long-term growth in what can happen into the world of our investments, particularly the economies and, of course, the stocks that represent them. And so we feel quite bullish that trends are still maintaining themselves and will still keep themselves in very much that angle for some time. Now, the only things we have to do into the short term really is to be able to be quite watchful of the potential price shocks that could come in, one as a result of short-term upward movements which have been relatively elevated. Hopefully we can see fundamentals catching up to those prices maybe in the medium term, and hopefully that could be able to solve some of the situations in terms of target prices being too nearby. And we might be able to see a counter movement in prices, maybe a short-term correction, which could be slight, or maybe a consolidation that could also ease up and give some time for the fundamentals to be able to catch up. And so really the recent run-ups are really the only things that we really have to be very watchful of. I think many of you have seen how prices, particularly in very pocket movements, have been quite sharp. We've even had things like rebalancing of certain foreign indices, and because of that, they had to be able to buy particular stocks into the Philippines, and also caused dramatic uprise in some of these issues. But that all paints the same picture. Our radar, or our part of the radar screen of the entire world, is getting bigger. And as more people are focusing on the Philippines, that can only mean that more liquidity heading into their direction, and that's why we feel quite bullish that despite corrections, we should really be looking for opportunities to pick stocks up. Now, just to give you perhaps a sense of that extendedness, I want to compare the performance of the Philippines in roughly in the year to date, which you can see here on the right side. And right now, we're almost the leader. The only one beating us right now from the year to date values is Japan, because, of course, Japan came a very low rate. Some of their economic numbers have been a little bit stronger than what people expected. So there was a very, very sharp bounce that took place into that market. But we did pretty good. We were up about 18%. And if you were to just turn time backwards, go 6 months backwards, roughly, or not, roughly closer to October, where we saw the lowest that many of the world markets experienced, our measurement into a rally came out about 38.5%. And that's quite tremendous if you're seeing what that span of time that you can see your index managed to climb. Yes, we did see that on a global situation, but of course you can clearly see us on the upper end of that particular streak, and that's why I've highlighted our ability to outperform all markets in that period of time. Looking that into the graph, you can see the red line is the percentage performance of the Philippines. This is looking at the point of view of 6 months ago. We had a bit of a fall first coming towards October. And after that bottom that most of the markets managed to experience, we've pretty much had a pretty straightforward story moving upwards. And if you notice, when some of the other markets and emerging markets started to correct, we hardly corrected. We actually just moved sideways, and then we blasted off again. And right now, if you can see, what we used to be the worst performer, now we're the best. And you can clearly see that the idea of it all is very much lasting, and that we're probably going to be able to enjoy more of that. So I would expect that correction should also be quite withheld or inhibited instead of being too pronounced. Now, also to be able to point out towards much of that extendedness, here's an index that maybe not too many of you look at. This is what we call the all-share index. The reason I wanted to be able to look at the all-share index is because this is showing you what all the stocks are doing in general. Because if you see nowadays, there are stocks that are moving are not in the index. And because of that, you're not seeing the total impact on how money is generated from many of these particular companies as well. So if you were to look at that very broad index, which encompasses everything, just look at what that index managed to do in the short period of time. And again, coming from that low in October, very, very sharp upward rise. And of course, in fact, the rise today, or if you can see as of yesterday, the distance from that up to where our next levels of support are going to be are becoming a little bit elevated. And that means if you were looking at your technicals very well and you're watching where your next major support areas are, they're actually a little bit far from where prices stand. And this is, of course, not exactly a very easy place to stand on, because if I'm buying a new position right now and I would estimate my risk, I would have to be able to base it on this lower end. So if my risk is relatively high as compared to my potential to move up, and the ratios I'm getting in terms of my reward to risk is not very, very good, then clearly you might have people who might want to wait, and that might put some profit-taking pressure off that market first. Now, what I've done is I've created a little bit of a gauge just to be able to give ourselves a semblance of how elevated push is, and compared. So what I did here is I looked at the value of the all-share index, and I compared that value with regard to the difference in price between the price of the index and the 32-day moving average. This is our short-term moving average, and every time that the price of the index goes a bit upwards a certain distance, the higher it gets, the more that it calls an eventual correction. And if you notice, on a lower end mean, which is this orange line that you see here, and this would mean that every time we see roughly about a 4% difference between the price to that moving average, in general we get small and corrective movements that could maybe last for a very, very short period of time, but it necessarily drives some profit taking first. But if that spread ever goes up to about 8%, which is not anywhere there right now, this is where usually the major corrections usually take place. So since we're not all the way up there and we're only in the first level of that, these are just typical corrections that may come out from these particular types of markets. So I don't really feel too much to worry about it, and I would see corrections to be a normal piece of the ball game as we'd come to be able to move along. Now, looking back into the Philippine Stock Exchange Index, we could also see some clearance between current prices and where our trend lines are, or where our next levels of support are. And maybe just to give you a valuation on that, roughly with your index being closer to about, let's say, 5,120, looking at a difference of about major support closer to about 4,900. So you do have roughly a disparity of almost between 200 points to maybe even 300 points or so, maybe if the market moves up a little bit more. And so there is that play around level that we might see the corrective pullbacks that take place in. So that's about the only thing that we have to account for in case markets do decide to show a hiccup as of this point. But clearly the trends are very strong on the upward movements, and hopefully after, of course, the short-term extendedness can be addressed, I think we should be on our ways to be looking at the higher end targets that I have placed here between 5,300 to about 5,500 looking at the end of this year. Now again, adding of course to some of the positioning into the sentiment, I have here the volatility index, and side by side with what we call the put-call ratio index, and just explain a little bit of both. These are sentiment indicators that watch how the crowd behavior of investors are behaving. In the first one, in the volatility index, if these values fall somewhere here in the lower end of this particular band, which is where it is right now, and by the way, this is the volatility index in the United States, it is telling you that we are already in that condition where the investor is coming towards that point of being a little bit too bullish. And usually when this happens, this is where consolidations or corrections usually manifest. So again, that puts up another alert for us that certain profit taking could be coming in perhaps into the short term, and that means that we still do have to be very watchful of some of our technical stops just to be able to make sure that we can protect ourselves. And in this other indicator, which is put-call ratio, if you'd like, you can look at this ratio as looking at all the people who are trying to short the market as compared to trying to go long against each other. And this measures that in terms of their volume capacity. And simply what this is trying to tell you that although this is on the lower end of this entire band, it is not yet in that point where people have become too bullish. So this is not showing too much of an extreme, unlike the VIX. But usually when both of them are reading on the same element, and that's when usually corrections are more material in terms of their value. So this one not too bad. This is about the only hiccup that we might have to also worry about. Now, the other reason why I am also not too worried about current markets is because where I feel that the market phase in. Last time I spoke with you, I told you that the Philippines is coming or pushing into what I called wave 3 of an Elliott wave cycle. The rest of the world was still moving or passing through wave number 2, and eventually they've managed to break above that areas right now. So it looks like most of us, not all, but most of us are inside this zone right now. And I hope that that could put a little bit of a smile in your face, because even if we do get a correction, there could still be another advance waiting for you. And if we were to be able to justify what wave 3 would look like, I've put some of the elements inside so you can see what the wave 3 usually feels like. And usually wave 3 is the longest upward wave. And so it usually takes some time to do this, because we are coming from a point where there is disbelief that the recovery is proceeding. And I think that's very clear. With the many lunches I've had with April, and she says whenever I come inside and talk to new investors, the very first thing they always ask her is, what about Europe? What about Europe? What about Europe? And what about Europe? So now let me ask you, what about Europe? Europe will still face its problems just like the US faced its problems. And you can clearly see that everybody's putting their thinking caps on to try to be able to solve that problem. If we sit down continuously pessimistic of that situation, we will never be able to move. And that's why, I've always tell my fellow attendees of my technical analysis classes, we have to understand that there is risk in every part of the world. But if we stand to look at that risk and we're paralyzed by it, I will tell you, scared money never makes money. And it's because of that that we should really try to be able to put that into the backside. I'm sure people out there will be trying to fix their problems. We just have to be able to manage how we're seeing the flows and how we can try to be able to participate into them. In also wave 3, we'll also see that we will eventually come out with positive news. I think you've also seen April. There are conditions we've been seeing upgrades into our markets, not only in ours, in some other markets. Hopefully we can see a few more. But that all comes in gradual context of time. We have seen earnings taper down a little bit with some companies, but we need, like I said, fundamentals have slowly to catch up with the movements in price, and that is about the only adjustment that we're going to be seeing perhaps in the short to medium term. And of course, on the latter end of wave 3, that could seem very much like a bull market run. And if you were to look at that in small scale, we had some issues that have actually been surging lately, and it would feel like that, but in a much, much broader context. And this is usually what happens coming towards the latter portion of that wave 3, before, of course, the wave number 4, which is another corrective wave, will come to pass. Now, last time I also met you, I drew out a graph of the US market up here, and at the time, I was showing you this part. This is what the US was going to last time, but I have to let you know that this graph was generated back in 2004, and I was just making an inference based on what I saw them last time and trying to use that with what the US market would do again now. And since then, if you were to be able to just keep this in your mind, the US markets have bottomed out in October. They've broken up through that high, and they're slowly going up and down, pushing up the way things were supposed to be. On the Philippine standpoint, if you were to look down here, we had a similar corrective movement. It pushed out, pulled back, and here we are again moving higher. And if you were to look there, remember, this is a historical graph, and this shows you that you could still have some upsides being groomed in. But eventually corrections will come, and maybe even a major one, but I would feel major corrections would likely take place just like what you saw here. Instead of big cascading declines, perhaps something more orchestrated in time, like of course consolidations like this. It might not even be that long. But clearly you have to be able to fix that disparity between prices and earnings, and by moving sideways or by adjusting itself one way or the other. Here we are, we're now pushing back up. Hopefully we can still have a few more advances into the short term before any corrections come out, but clearly we have to start being watchful of those things. I'll just tell you what to be watchful of so that you know how to be able to prepare yourself. But despite the corrections, I still feel that corrections should still look like this, and you still have another upward wave to be able to expect after that. So our lineup really is to be able to stay tuned into the advancing theme, because that has not changed. And of course, we want to be able to watch full potential reactions and of course rotational swings that will take place in markets, because as one stock moves up very, very fast, you'll get the profit-taking cue in there and money will go into the next one, and you will just have that reorder themselves over and over again until something changes. And so far nothing has changed in that, and so we should keep that climate very much going. The only thing we have to be watchful of as traders is to be able to be watchful of course, the extremes. You get a huge surge in price, some profit taking will clearly ensue, and you will have the reactions that will come from that. So the only things you really have to be watchful of are extreme overbought conditions that can manage to be able to pull markets down, but don't let that get you pinned down. Just look for the other things that you can come around to be able to move back inside. Those particularly coming off consolidations or manage to be able to make reactions back to support, those will be the next picks that you're going to want to have in mind. And of course, our ability to mitigate risk as of this point is really going to come in your strategy and how you do this. This is not the point in the market when you buy everything all in one go, all in one stock. All right, so you want to be a bit more tempered in your approach. I mean, you want to be able to look for issues that have managed to make consolidations, move some in there, try to be a bit more less concentrated on one or two stocks, but maybe look for maybe a range of about 3 to 5, maybe even 6 stocks if you'd like. And then, like I said, when you see huge surges, take a portion of your portfolio there out in terms of profit taking, and then wait for the pullbacks to be able to move it back in. And so that's one way for you to be able to handle that. But please be prepared. Usually at this point you will see a bit bigger amounts of volatility, but perhaps not too tremendous. But these are the things we have to be very watchful of, especially after advances, because volatility creates weakness. And as that weakness is generated, this is where wider corrections usually take place. So let's try to put that in picture form for you to try to be able to work off the strategy. So here's one of our, of course, stock picks, as April pointed out, Metro Bank. And you can clearly see Metro Bank's been a very, very nice advance recently. And particularly in the last few days, we had a nice upsurge until what happened earlier in today. But try to put more understanding into that. We've been channeling upwards. Every time it gets a surge, it corrects for a while, surge, correction, surge, and perhaps we'll probably get another correction. And so you can see that there is some controlling element to this space. And so if you were to focus on the right side of this, the whole idea is stop trying to keep buying stocks whenever they push up very suddenly and very sharply. Right? Because you will see that the profit-taking conditions will handle themselves on their own way, and you can buy them when prices move back to a much more meaningful price level, which is closer to your support range. So try to be able to buy them closer to these areas, not up there. So try to understand where those concentrations in buying conditions are going to be. After all, the technicals still look good. Your MACD readings look good. We have DMI, ADX readings are still telling you momentum is still very strong. And the only thing we have to worry about is that, yes, their market was overbought, and that's the reason that you have to go through conditions like this. As in always, we will always put our stops where major support is, so just in case these things break and a wider one perhaps is necessary, maybe we'll get a chance to buy here one day, but maybe not right now. We will just continue to do range trading or swing trading within that channel, because that is what the strategy for this particular moment is going to be. Let's look at Metro Pacific. And if you were to look at Metro Pacific, it went through a very long consolidation for quite some time. It was very fortunate enough that you had an English index average managed to increase its weighting in this particular stock, where all of a sudden you had, of course, a heavy amount of funds flow come back into the issue. And we've had a pretty nice run-up recently. Now, coming from roughly 370 all the way up to 420 in a matter of days. Clearly, will suggest an overbought capacity. You can clearly see the RSI go over 80, and that is clear overbought condition. Although many of the other momentum readings are still solid, again, it just needs to be able to make a reaction to be able to fix that overbought condition. After that, the uptrend should be able to maintain itself. And here's another one I'm sure you probably are looking for. Every time I come up here, people always ask me at the end of the conversation, how come you never talked about any of the fast ones? Well, We try to be able to promote, of course, long-term fundamentals into companies. Some of these faster ones that you like to trade so much have their fundamentals still going, or still in the infancy of them. And that's the reason why, of course, the lasting nature of some of these things are very much in question. Now, there have been some, of course, there have been some stories coming in through each of these individual small cap runners. And of course, you have to be able to keep your ears open to listen to some of these stories, because some of them are stories for prospectful futures, and keep an open mind. But as you come inside to trade them, I think your aggressiveness inside should be quite tempered. And what you should elevate, though, is your ability to manage your risk. So if you're going to be trading stocks like this, and clearly I know you can make a lot of money going forward trading issues like this, look, I mean, you can have huge surges, worthwhile corrections, breakouts from those consolidations. You can move back inside here. You can use your technicals to give you the buy signals. You can use momentum indicators to tell you whether it's moving very strongly or very weakly. You can clearly see that it's strongly in terms of what you're seeing through here. And again, we just have to be very watchful of elevated prices, because we did go through an overbought condition. So don't be surprised if we could go some profit taking soon after this guy starts to water down a little bit. But it doesn't change the fact you can participate in here, but there's something that you have to be watchful of. That's volume. If you guys are going to be buying small cap stocks, you have to be looking at volume all the time, because you don't want to buy a company whose volumes are extremely low. Even though if you see, whoa, it went up 30% today, but there's hardly any volume being traded. You buy that today, will you be able to sell it tomorrow? And that means that you cannot watch your risk, because on the way down, you're at the mercy of what the price will be, and you cannot sell. So just be very watchful of that. I think as a general rule, if the average daily volumes, let's say for a particular stock, is, let's say, 10 or 20 times more than what you want to buy, then that's the only time that you can justify entering into that. That means because you can easily go in and out. But if you see the volumes trickle down, and sometimes trickle down tremendously, then I think you have to be able to either contain the amount of money that you put inside, and controlling volume becomes very, very important, because just in case you get dry ups like this, when pullbacks like that, at least that you might be able to manage yourself off that, just in case it warrants doing that. So you will get a lot more issues like this moving, because this is the type of market that does it. When you get some profit taking in one, it will look for other issues to move up through. And I'm sure maybe some of you, like I am, starting to get a little bit tired of some of these things, because there are just quite a number of them. And to be able to prove that, in fact, I will show you in a little while what my technical guide upward trend list looks like, and how many stocks are focusing on that. But before I go in there, let's just focus on some of the issues April was talking about earlier. So lining up her fundamental picks, I've managed to be able to check all the trends of the stocks she pointed out to you earlier, and each one of them showed their short-term trend status to be clearly up. And you know, that's very rare that I come to speak in an audience like this and tell you, because usually there is ups, sideways, but here you have everything all up, and I think that can tell you or picture you very much the mood of that. And you can clearly see what the positioning of some of the short-term moving averages are, and again, prices are all above them, and that is very much suggestive of a very, very bullish market. We just have to be a little bit watchful of the elevated RSIs over 70 or 80% in particular. These are the ones that can cause some struggle into price and force in some profit-taking activities. But if they can water themselves down below 60, that should be able to be a much better area for you to watch out or look back into those issues. And if some of you are actually reading our research pages, and you're actually looking to see which ones are showing more technical quality, or let's say in a market like this, of the coverage that we're looking at of maybe over 200 issues, you can see how many of those. This is roughly 51 stocks, all in uptrends, giving you relatively solid readings. So that means your environment for investment, particularly for short-term trading, is going to be quite vast and large. And that's why I know some of you might have very difficult time trying to choose it, because it's walking into a candy store today. You don't know what stock to pick. And I can see how sometimes that might be a bit difficult to be able to bear with. But like I said, if you don't want to be able to focus in I would suggest pick out the companies you feel very fundamentally solid about. Try to pick off a range of maybe 10 to 15 stocks, perhaps in that list if you wish, that coincides particularly with what April told you. And choose them fundamentally and trade them technically. Wait for the pullbacks, wait for the consolidation, allow prices to break loose, allow your momentum indicators to move in along with you, and those should be the issues that you should be picking in. Never mind if the stock that you bought goes up 5 or 10%, or the other one goes 20. Right? I mean, we can't have everything all the time at the highest price. And that even at 10%, that's much, much more than what you're making in a bank right now. And so try to be able to feel justified with what you're doing. Because if you're taking too much risk on a particular portion where the market's a bit too high, and that's where, of course, some sorry statements may eventually come up to be able to move back in. All right, so anyway, as a wrap, I think it's very clear. Much of the things we looked at are very, very strong markets. And we feel that, of course, the market will maintain this bullish attention, at least into the short to the medium term. Clearly, liquidity is still going to be the pressing element inside a low interest rate environment, with money not having too much of an option to move out to. Money will stay into the equities market, so you can still see more into this despite corrections coming up. But it is a reality that we're going to have to be able to deal with. Reactions will be around the corner. I just don't know if it's going to come tomorrow or next month or in the next 2 months. But let's just make sure that we're prepared. So we start seeing triggers like a break of the 32-day moving averages, or perhaps prices breaking the 16, going to the 32-day moving average. We already should know where we should be marking out spots for an eventual buy-in. So just prepare your mind for these particular conditions. And do understand that, of course, as uptrends would direct us as being, of course, the technical traders that some of you are, the whole idea is to be able to look for the proper setups to be able to move back inside. Right now, with prices being a little bit too lofty, it might not justify the risk. One way to do it is to limit the amount of buying that you're doing for the meantime. When prices come back down, maybe you can buy the rest there. And so there's different ways to be able to manage yourself well inside there. But this is the interesting part, because we haven't had that much options long time ago in the past to be able to take advantage of markets like this. And now that you see markets are very powerful with good liquidity, with good stories, the last thing you want to do is tie your hands behind our back and say, I don't want to participate anymore. And you see, this is the learning lesson I've gone through. Of course, exciting markets and, of course, very weak markets appeared before. We just have to make sure that despite everything, you have your strategy inside. And while the strategy maintains itself, it doesn't matter what market that you have. You always have room to be able to justify what you're doing because you're avidly protected at all times. And with that strategy, you can work yourself up with any market that you want. So that brings me to an end of my presentation. I'd like to thank everyone again, and nice to see you all.